Good afternoon, everyone. My name is Johnathan Levin. I'm a columnist with Bloomberg Opinion, and I'm here with some friends and colleagues. John Authers, author of The Fearful Rise of Markets, and my colleague here at Bloomberg Opinion, as well as Kathryn Rooney, chief strategist for StoneX. We are here to talk about the Fed. We have a Fed decision coming down the pike in just about 4 minutes in change. Little graph on the first slide for everybody, just to give you a sense that there is a unanimous expectation that the Fed will effectively do nothing today. That is at 5.25 to 5.5%. You know, I take some positive signal from the fact that there is this unanimity. I've graphed the median survey expectation in blue, and then the high survey expectation and the low survey expectation in white and gray, respectively. And for much of this cycle, as you could understand, there was a good bit of uncertainty about what was actually going to happen. But for the most recent two meetings, inclusive of this one, everybody seems to be pretty much on the same page. You know, one other thing I wanted to show you, looking a little bit further into the future, there is now this sort of widespread and growing expectation that one way or another, cuts are coming in 2024. And a discussion about how much they might cut and when they might start doing it. But if you look at the signals from the Fed's SEP itself, from consensus forecasts from Wall Street, from Bloomberg Economics' own models, and from the futures market, everybody is looking at a shift in policy coming next year. One final point on this before I have my esteemed guests here. You know, the market has expected a pivot a lot in the past, and these sort of light yellow lines represent past point in time expectations for the path of Fed policy. And you could say to a certain extent, since like mid 2022, we've been looking ahead to the pivot. So are we foolish to be getting so excited about the pivot once again? I don't know, but that's why I have smart guests here with me. Kathryn, what's your expectation here today? Will Jay Powell validate some of these market expectations for some cuts, maybe even significant cuts in 2024?
He may remove some of the language, which has been generally hawkish in tone. And if he does that, then that confirms some amount of expectation as pertains to rate cuts. As well, the dots plot is very likely, in my opinion, to stay showing a 50 basis point reduction for 2024. If they go more than that, they're sounding exceedingly dovish. I think the question, though, John, at least from my perspective, is how much does the Fed do next year? I think the Fed cuts in either one of two scenarios. One, because the U.S. economy is in recession, and two, because real rates are moving dangerously higher. So that means immaculate disinflation continues. Soft landing is the story. It's happening right now. That continues, and the Fed deems that nominal rates are just too darn high to and risk the economic activity, which in my perspective is already slowing. So I do expect the Fed to cut next year. I think it's toward the back end of the year. And I think the markets are probably in for a bit of a surprise because they're very aggressively discounting a Fed starting in March and going a more than 100 basis points next year.
Okay, John, I'll cut you off when the decision comes here. Yeah. But you wrote in your great column here that markets are more alarmed by bond vigilantes than they are by the prospect of central bank cuts. What's up with the bond vigilantes right now, and why have they stopped doing Jay Powell's bidding?
Well, perhaps because they're doing Janet Yellen's bidding, that the Treasury Department is doing an extremely good job of nursing the market through these huge new gobs of debt they're issuing. You know, both the auctions this week, which were brought forward so as not to clash with the FOMC today, went very smoothly, with the result that in yields. Oh, look at this. The
Hey, John,
no change
yeah,
at all in interest rates I see on my Bloomberg. Yeah, go on.
shocker. They
Shocking, yeah.
they stand pat. They do nothing. Let me just read out a couple of headlines that are hitting, and we'll get back to that. So Fed obviously holds the benchmark rate at 5.25 to 5.5. Fed says inflation eased over past year but remains elevated. Huh. Okay. Fed will assess the extent of, quote, any additional firming needed, sort of keeping that conditionality there. And FOMC median forecast shows 75 basis points of cuts in 2024 to 4.6%. So, John, I'm gonna let you get back to the point you were making, and while you're doing so, I'm going to pull up some of these numbers and see if I can't flash them on the screen for folks.
Sure. Now, I think in many ways what's most concerning markets at the moment, particularly since Congress has found it so difficult to agree on a budget, is the notion, and also with Fitch's warning not so long ago, is the notion that bond issuance is going to force yields upwards, whatever the Fed wants it to do. In terms of the dots, which I'm just looking at now, eyeballing them quickly, 10 FOMC members expected rates to be 5% or above by the end of next year in the September meeting, and that number is now down to only 3. So there's a fairly significant retreat from the real attempt to look hawkish and scare people a bit from September. There's only one outlier who thinks we're going to go below 4. But plainly, if people expected to see quite a retreat in the dots, and they've got it, and that's going to make life quite difficult for Powell if he wants, as I think he probably will. If he wants to send a bullish, a hawkish warning, that's going to be harder in the face of dots that suggest the Fed is getting more dovish, is getting more relaxed.
Yeah, and if I could just call out the median here, I'll sort of circle it with my cursor, and in fact, let me just blow this up for everybody. So the median forecaster among Federal Reserve Board members and Federal Reserve Bank presidents now expects to see Fed funds rate at the end of 2024 at 4.6%. That's down from 5.1%. I do think it's and I do think it's interesting that, so part of that is coming from revisions in core PCE forecasts themselves, right? So they revised down where they think core PCE will end 2024. They used to think 2.6. Now they're at 2.4. But some of this is actually coming in the form of narrower real policy rates. They are simply looking at this and saying, a slightly narrower real policy rate, may do the job here. I guess, Kathryn, can I ask you to put on your, your J Powell hat, or your J Powell like Grateful Dead T-shirt kind of thing? Does that make sense to you? I mean, in a way, it's like a return to expectations a few months ago, but are they being too easygoing about the inflation challenge still ahead of them?
Well, I'll add on to what John Authers mentioned, which I think is correct, that Jay Powell in the press conference today is going to have a tough time jibing the two, the dots plot showing additional rate hikes than we saw in the September meeting. So there's going to be a lot of questions, and my suspicion is that he's going to sound hawkish. I think he's going to try to push back because what we've seen now, I'm just looking at the communique, any additional rate hikes. So the any was added to the communique. So the communique, the statement was dovish. The dots plot are dovish. Fiscal, the financial tightening, financial conditions are loosening. So I think Jay's going to have a tough time. I think he's going to be my suspicion is pretty hawkish to counterbalance what we've seen at the 2 p.m. announcement.
Okay, I did just want to make sort of a nerdy point real quick, which is that you may take some comfort in the idea that Fed policymakers' evaluation of R star, this sort of neutral state interest rate that will prevail in the longer run, has not moved up. There was quite a bit of noise about that, especially around the time of the Jackson Hole speech. And I actually saw a little bit of movement in that in other surveys, but policymakers, the people who are actually making these decisions, no change. And even sort of looking under the hood, not really any change in any meaningful change in the central tendency or the range itself. Sorry to cut you off, John. Please jump in there.
I mean, what concerns me a little for Jay Powell at this moment is that we are getting to this, the inherent contradiction or collective action problem, or whatever you want to call it. The last FOMC, the last FOMC with dots was the one where Powell talks quite expansively about how tighter financial conditions were doing the Fed's work for it, how helpful that was, and basically providing that as a nice hint that if you keep conditions as tight as they are now, we won't.
Right.
According to my screen at the moment, just with my trusty WB screen up at the moment, 10 years down 10 basis points since this announcement came out. I assume that both the communique and the dots give that away. We're now down to just below 4.1% on the 10-year, which is quite startling, and we're below 2% on the TIPS 10-year. So plainly, the market isn't doing the Fed's job for it at this point. It isn't helping. I'm not quite sure, given what is in the dots and in the communique, what Jay Powell can say, other than please, please sell some bonds. Please, guys, help me here. Other than asking for a favor, it's difficult to see exactly what he can do or hint at to get people to tighten conditions from. I think that's probably a reasonable enough initial reaction. It's unusual in recent months for there to be this bigger reaction in the markets before Powell starts to talk. But I guess the dots and the communique are emphatic enough this time that people are have taken yields down swiftly. But I think this does become a real problem, because with the markets getting this much more lenient, 3 months ago the argument was this means we don't need to hike much more if you're being this tough. Now the argument is, well, actually we don't need to cut because you've eased so much. Mr.
Yeah, that's a really good point. Yeah,
I mean, I don't really. I think the market is making it very hard for the Fed to ease in the first half of next year if these numbers hold up.
We could be in for a rocky road next year, don't you think, John? I mean, if the market is discounted from a market's perspective, I mean, from the StoneX trading side, what we've been seeing is aggressive positioning and a tendency to probably sell right now and profit take, because the Fed did come out as dovish as was expected. But what I'm interested in, John, Authers, and Johnathan as well, is what does the Fed think about long and variable lags? I mean, is the Fed considering is this an aberration from reality? This is just sort of a a delayed effect, and we're going to see the impact of real rates finally pinch the U.S. consumer. I think we're starting to see a bit of that. And then finally, what is the Fed going to do with quantitative tightening if they're cutting? They would keep it on autopilot, but those would be some of the things that I think that Jay Powell is going to talk about in the Q&A.
Yeah, I mean, Powell has tried to establish the principle that those two things can move in opposite directions at different times in the past. I agree, it's a difficult one. I can see leaving rates unchanged and doing something to buy or sell bonds, or vice versa. The idea of actively taking them in contradictory directions is fairly hard to swallow. I think the other problem you do have next year, in terms of it being a tough year for markets coming up, is politics, and it seems a little silly because it looks as though we're going to have a choice between two candidates, both of whom appointed Jay Powell for a term at the Fed, and both of whom started their term with an absolutely massive fiscal stimulus. Different kind of fiscal stimulus, but basically they did much the same thing. Neither of them is going to be able to do a big fiscal splurge starting in 2025. So in some senses, it's ironic that politics comes into this, but the number of people out there who are suggesting that if the Fed wants to cut rates at all next year, it might feel that it needs to get a cut in ahead of when it thinks it's necessary, for it to be far enough ahead of the election for it not to appear to be politically motivated. I'm not sure myself. I think to some extent that's a symptom of the levels of distrust and the steady weakening or erosion of confidence in institutions. Because I wouldn't see a Fed cut and think, oh my God, they're trying to help Joe Biden there. That wouldn't be that's not a thought that would particularly enter my head, just as I haven't thought that they're trying to harm Joe Biden by hiking for the last 2 years. But plainly, we're in a world where lots of people will make that interpretation, and it may affect the Fed's behavior. And markets aren't good at judging politics. They're not great at judging rates, but they're really bad at judging politics.
Hey guys, I wanted to just do a real quick side note here, because we made a couple of references to the statement itself, and I wanted to bring viewers along with us for the ride here, right? So essentially, of course, this is the main policy statement that the Fed puts out. They are very judicious in the way that they tweak this thing, if at all, on a meeting by meeting basis. And so I'm going to walk you through the tweaks that they have made. The first tweak that they make to the statement is the way they talk about inflation, and you could see why the market might see this as sort of dovish. They used to say, as recently as the last meeting, inflation remains elevated, but now they say inflation has eased over the past year, but remains elevated. So, it might seem like a minor tweak, but in central bank world, it is significant, and they don't do anything by accident. The other change is the one that I believe Kathryn already pointed to, but I just wanted to give everybody the sort of full context here. So they add a little bit more conditionality to this part that I've now highlighted. They say right in here, in determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, and so on and so forth. So it's the addition of one word, but again, everything here is intentional, and so that any suggests that the odds of them going any higher at this point feel increasingly de minimis, at least until or if we see evidence of a reacceleration of inflation. I did want to raise sort of a general question. I'm going to take this off the screen real quick. General question being, like, we're here talking about the Fed, but like the Fed hasn't mattered to a large extent in this process of bringing inflation down to date. At least many people have convincingly argued that, and I've seen convincing breakdowns by respectable economists that suggest that so much of this disinflation to date has come via the supply chain channel. Demand has not been a huge factor. We've been able to run growth at an extraordinary rate in 3Q, even with nominal interest rates as high as they are. So, like, does any of this matter? Like, do we think a switch is just going to flip in the next couple of months and it's going to start mattering more? How do you both think about that?
If I can jump in here, I think that's the most important question. Companies have benefited remarkably from low real rates, even negative. Now they're positive. The consumers have benefited from low real rates, even negative. Now they're positive. Companies are now facing additional margin pressure from a triple whammy of still high labor costs, high energy costs, and high interest rates. So the job hoarding phenomenon, I think, could unravel. And I think that that's going to impact the consumer. So the consumer faces the potential for job loss next year, high and rising real rates. And as per the San Francisco Fed, Josh Shapiro does a great job with this, Johnathan. And they estimate that the pandemic-induced liquidity injections are going to evaporate by the beginning of next year. So that's also a headwind for the U.S. consumer. So I think it does matter, and I think I'll finish with this, John, which I think is the Fed cut 75 basis points in my view with the soft landing, with no recession. But if we're talking about unemployment jumping, which I think is required to really get inflation tamed, then the Fed could, in theory, do the more aggressive 200 basis points. So I think it all comes down to how the economy evolves, and specifically how grave, or if the U.S. consumer does roll over. And I think what we've seen is an aberration from reality, not a new economic reality here in the United States.
Yeah, but John, do you think like we talk about long and variable lags, for instance, do we think that is there a world in which that just happens like overnight and we wake up and it's like boom, or is it a kind of a slow burn that we can see happening in the data and maybe policymakers can even react to?
Well, there's the sort of Malcolm Gladwell-y concept of the tipping point. Then those two aren't completely mutually exclusive. That things, or Hemingway, that people go bankrupt gradually and then all at once.
Yeah.
So you can it's perfectly plausible to see very steady deterioration or shift in conditions followed by then something very startling at a point when people really grasp what's going on. I'm not necessarily predicting that that's what's going to happen. I don't think there is anybody seriously who denies that 2021 was a policy error. If not hiking rates in 2021, continuing to do QE at full tilt and denying you even thinking of stopping it during 2021 was an awful error, which I mean, he didn't use the word awful, but Jay Powell has said that it was a mistake with hindsight, that if they know what they know now, they wouldn't have done it. I do suspect, and this is where the debate about higher for longer, I think I'm the first person to use the phrase higher for longer in this chat, oddly enough, because a couple of months ago, the whole thing would have been framed around higher for longer. The point around higher for longer is that one of the lessons from 2021 is the longer rates stay at a given level, the more of an impact it will have. So many people locked in generous, very low fixed rates because they got such a long window of opportunity in which to do so, that this lag is longer than usual. I doubt that this lag is eternal. But the longer you keep rates at a plateau, the more likely it is to finally have an effect. The whole thing ultimately comes down to the fact there is no good precedent for the COVID shock, like literally none. With an economy and with financial markets anything like what we we have now. The closest approach in 1918, there was a war going on at the same time, and you can't really discern effects. So we're all guessing about how this shock, how the pig is going to go through the python, how the ripples are going to move through, and I still think there is quite a real chance that rates do need to stay high and that they will eventually have an impact, simply because at the moment inflation, the transitory elements of inflation were transitory and have gone. Services inflation is everything at this point, and services inflation is driven primarily by, well, it's either wages or it's houses and rents and mortgages. These are all things that are very directly linked to monetary policy, which are too high now, while the gains that have been made so far are not particularly linked to monetary policy. So I do buy an argument that the lag will eventually, that this will happen, and I do buy the argument that rates do need to remain somewhat elevated if we're going to get inflation back down to 2.
Is that effectively an argument that you may well need some economic pain, so to speak, to get the job done, to get back to that 2%, that the proverbial last mile is going to be the hardest, as they say?
I can go along with that. The only really soft landing, in my opinion, was mid-90s. When you had the peace dividend, when you had this sudden influx of very cheap labor from Mexico to help out, and where the rate hikes that Greenspan had pushed through in 1994 did cause a chain of crises throughout the emerging world, just not in the States. That was a genuinely soft landing. I first came to live in this country at that point, and it felt as though there was just nothing wrong with living here. It was just things seemed so good. It may be my lack of imagination. I cannot imagine a truly soft landing like that this time. Too many things are not in position that were in position back then.
If I can jump in, John, I think it's so interesting because I think the soft landing is happening right now. I mean, we definitely have had a disinflationary process that has been, I mean, really tenacious and aggressive and truly impressive. But the duration of that, I think, is what's overestimated by the market. Soft landing is not forever. There does come an end. So this no landing scenario where you have 525 basis points of hikes over the course of a little over a year and a consumer that remains resilient in the face of real rates moving higher, I think is probably not as high a probability as the market is currently discounted. The consumption-driven U.S. economy is already showing signs of slowing. We see delinquencies moving higher. We see bankruptcies moving higher. We see 50% of all banks tightening lending standards. So if you can get a loan, you're getting it very expensive. And I think that probably means that I agree with you, John Authers. I think we're probably moving into some form of recession. The good news, and timing of that is infamously difficult to predict, and no one really can. But what I would say is that if you look at where nominal rates are right now, more likely than not, I see a scenario where the holds for the entirety of the first half, maybe starts to cut towards the end of next year. But I think that the risk of reacceleration of inflation under a continued soft landing is very high, because as you said, John, what I would agree with and add to your point is that the main driver of the U.S. economy is consumption. 2/3 of aggregate demand is attached to the U.S. consumer. What drives consumption of services, which is currently the main driver of core PCE? That's the job market. And if I have a job, and if I'm seeing wage increases, and those increases are even beating inflation, I have no earthly reason to change my habits of consumption. I'm going to continue my discretionary spending on services, getting the weekly nails done, renovating your house, going out to dinner with your family on Friday nights. That's not going to change. So I think what it comes down to here is, does the Fed have a strict or loose interpretation of its dual mandate? Will it absorb a 2.5% or 3% core PCE to avoid recession? Or does it have a strict interpretation and try to claw back some inflation fighting credibility by doing whatever it takes, including pushing the labor market into some difficulty to get to that 2% strict target? And I think that's, for me, the biggest question for next year.
I personally think it has to be the latter, but I might well be wrong about that. Obviously, politics matters. It's going to be very difficult to hike in September or November cuts in September or November and then get on the receiving end of what Donald Trump thinks about you for doing that. You can see why that would deter people.
But Jay's not afraid of former President Trump. He's shown us that, right?
Yes, indeed.
John, do you think there's a good chance of no cuts next year?
No, I think that would be surprising.
Okay.
If there were no cuts at all next year, that would imply that some pretty serious. The economy was continuing to behave in a very startling fashion. It would mean that we'd had no serious financial disruption for all the remarkable things that have gone on, and it would imply that the labor market had still not really loosened very much. So I find that unlikely. I think it probably would be good news if there were no cuts next year. I mean, this is a key point about the market hoping for a pivot. The last big pivot, the Powell pivot at the end of 2018, did indeed make a lot of people a lot of money. Generally, you don't want to be in the market when the Fed pivots, because it realizes things are worse than the Fed and everybody else realized, and you don't want to be in the market when that happens. So I would still feel very anxious about that. But I mean, the final point in terms of monetary policy, this is where democracy is difficult, where politics is difficult. We seem to have learned in the last year or two that people really, really hate inflation, and the fact that more or less everybody who wants a job seems to have one doesn't help with that. People still bitterly resent inflation, and whether we would find out they really were okay with it if the Fed did what was necessary to push it down to 2% and cause people to lose their jobs, we don't know yet. But it certainly looks to me as though there is this, that there is a mandatory need from the populace for the Fed to carry on with this, and that it becomes quite difficult for them to cut.
One final thing that I wanted to throw out here as we wait for Jay Powell about 2 minutes from now. What about productivity, right? I mean, it seems to me that if you're going to make a strong bull case here, it largely has to be about productivity. But on the positive side, we have seen some good realized productivity numbers. And there are a couple of good theses that would make the case for productivity. If you want to be a little bit fanciful about it, you could form your thesis around AI or something like that. But you could also say all these people just came into the labor market. They were slow to figure out their jobs and so forth, and now they're getting it, right? And so maybe we do have some meaningful productivity ahead of us, and that could mean things like sustainable wage gains without inflation. Do you think I'm being too pie in the sky about that?
I think the best thing that could happen to the soft landing camp and the Fed is that productivity that we've seen at this pace, which is a torrid pace, and it's fantastic. I don't know if it's sustainable, honestly, because I think it has to come from a whole-scale adoption of AI, and that's just not happening right now. It's kind of the buzzword, and all the corporations love to talk about it on the earnings calls, but it's not actually being executed. So I think if we did get a sustained 4.5% annualized productivity growth, then we could absorb a reacceleration in inflation. I think Mohammed Al-Arian had mentioned that point as well. And in that scenario, the soft landing scenario, the Fed can cut 75 basis points and the S&P continues to rally. It could be up 10% next year. But in the hard landing scenario, and this is where I think the markets are getting a little bit ahead of themselves, because we're all thinking, oh, it's great, the Fed's going to cut, bond yields are going to come down. That's going to be positive for equities. Equity risk premium looks more favorable, but not if it's a hard landing, not if the Fed is cutting next year because there's a contraction in aggregate demand. If that's the scenario, that's bullish for bonds, but that's bearish for equities. And I think that earnings will be downwardly revised, and